Well, good afternoon. One of the gray beards is without a beard, the other
The
is
other
with
one
a
is in
beard.
Mexico with a beard, yes, on holiday. But
So here
he's
we
been
are.
watching.
So here we are, big day today. So, what we had from Powell was a 25, the FOMC meeting today was, a long awaited meeting and fairly consequential. Though we'll see what we think about it in terms of your investment. The the news was pretty straightforward. The Fed hiked 25 basis points and continued to pursue quantitative tightening through selling their bonds, and that continues to operate in the background, but still important. And the commentary was measured, I thought, and represented, the basic thing we've had that's the result of the banking crisis. We don't know the impact that move of deposits away from small and mid and regional banks to big banks and money market funds is going to do for the extension of credit to the economy. And Chairman Powell was quite clear he doesn't know either. And by not knowing, he knows what it will do if there is a credit contraction, and that will act like a tightening of financial conditions and aid the Fed in their fight to tamp down inflation. He was very clear that financial stability is being managed with other tools and believes the banks are in good shape. Um, and so it's a fight with the fight for inflation wages on, but now it's being potentially impacted by a credit tightening. Nick, what was your read?
Exactly the same. Basically, everything that we said a week ago is coming to pass. The regional banks are in trouble. They need to deleverage, and that will cause a credit contraction, which is undeniable. What we don't know is how big the credit contraction will be and how much it will affect the real economy and how quickly, more importantly. We have a lot of data about how important regional banks are, especially for the real estate sector, probably accounting for something like 80% of commercial real estate, whether that's shopping malls or office space and things like that. That needs to be refinanced, and it'll be refinanced at much higher rates. A lot of that stuff will probably go bust, and that is something that's going to take time. I think what Chairman Powell today did is try to give the banks as much time as possible as he can possibly give them to complete this process of deleveraging and refinancing what they need to refinance for their clients. It's going to take time, and certainly what he said, I think, was perfectly fair. He does not know how deep this credit crunch will be, if it's going to happen at all. And therefore, I think what's going to happen here is that markets, as they're always forward thinking or forward looking, they will try to readjust equities lower by a few percentage points just in case the news is bad. But we won't know that news for several months. What do you think, Andy?
Yeah, I mean the way the credit impulse works is, firstly, in the last year, the U.S. banking system has has provided zero credit growth. So if you look at loans created, credit created, money created by the private sector banking system, it's been flat year over year. So the economy has been still performing extremely well, while credit has not expanded, and that's pretty rare when you have real economic growth without credit expansion. So the question is, will that continue with what is likely to be, like, regardless of what your views are, the middle and the regional banks and smaller banks do provide a lot of loans to commercial real estate, but those tend to be fairly long term and may not need a full refinancing, but they'll definitely cut into growth. I've seen estimates of between 25 and 50 basis points of GDP impact if the regional banks just stop providing credit on refinancing, and so contract credit. And the question is that enough? We won't know, and I don't know, but I do think that this economy is one in which labor and wages are much more important than availability of credit to keep this
Yes.
going, because we've seen a year's worth of no credit. Credit's supposed to increase along with the GDP. That's sort of how it goes. GDP rises, credit rises, and they rise in tandem. When credit rises more, GDP rises more. When credit falls, GDP falls. This time, credit didn't rise and GDP did. So it might be just a different economy. And as Nick said, the Fed doesn't know, and so we certainly don't either. I think if you'd say, what do you think? Um, this economy is less sensitive to credit contraction than past economies. And because of that, the credit contraction is probably not going to be as severe, which means that the Fed will once again have to get back on hiking. But they're going to have to be data dependent until they know. And so my basic synthesis is either the credit contraction over the next 2 to 3 months hits jobs, or if it doesn't, the Fed will be back in action. And in both cases, it's tough to be bullish equities.
Yeah. I think we are in a different economy. We're on the demand side now. I watched an interview with Jamie Dimon of JPM just yesterday, who was basically saying the consumer is in very good shape. Their checking accounts and deposit accounts are full of money still. And he estimates that it's going to take another 6 months for those savings, for those excess savings to be spent. Therefore, we probably have another, couple of quarters of not knowing um, if the economy is going to come off a cliff or not. Therefore, I think probably the prudent thing to do, because we know that the market is forward looking and the market is going to start pricing it in, is to reduce our equity allocations to our 20% minimum allocation and basically stick it all in FRNs, which are yielding you, well, they will start yielding you close to 5%, or something like 6 months bills until we know which way the economy goes. And then we can buy duration if we think the economy is going to come off the cliff. But I agree with
Right.
you. Over the next 6 months, we will probably know very little. And we are probably in a trading range in everything, bonds and equities. Equities are going to reprice 3-4% lower than here, I think, over the course of a month or so. So maybe reducing our equity holdings down to a minimum 20%. In the meantime, getting some yield on our cash through the FRNs and or bills, and then we see again.
And why don't you think we should go into fixed rate bonds across anywhere on the curve? I know I've been pretty negative on the short end of the curve, and if the Fed doesn't hike as much as unless the Fed cuts rapidly, the short end of the curve is still very rich to me.
Absolutely. The I think Chairman Powell was very clear. Cuts are not the base case of the FOMC, unless we start getting very good news on the inflation front and bad news on the unemployment front, i.e., unemployment starts rising much faster than
Right.
uh, than the market expects. So I think certainly for the next one or two meetings, cuts are off the agenda. That gives us time to decide which way the economy is going. Now, something like 2 year is very, very rich at the moment and is probably discounting something like 3 cuts in any case.
Right.
Fives are like from a trading perspective, but I'm not a holder. I'm not a buyer of
Right.
5 year
Three and a
paper.
half percent yield to hold doesn't seem a lot.
unless there will be a recession, in which case 3.5% yield is great because it's going to
Yeah,
go to
sure.
one. But
Yeah,
we will not know that for another 2, 3, 4 months. Therefore, we have plenty of time to make a decision, a judgment call. But in the meantime, I think what you cannot expect to go up is equities. I think
right.
uh, we will go down to our minimum 20% allocation. But if anybody wants to sell calls or anybody wants to go to zero, that's their call.
Yep. And just to close out, on the long end,
Of
10s and
bonds,
30s. Yeah,
well, as you said, that's where the banks need to deleverage. But to me, the yield curve is going to go pretty much flat, and then oscillate between slightly negative and slightly positive, and then make up its mind. Because if it's recession, it's going to go positive very, very quickly. In the space of 2 or 3 months, it's going to go 100 basis points
but you don't think we
towards the
need to
positive.
chase because we don't know. You don't think we need to chase a recession,
I don't think we will be any the wiser over the course of the next 2 or 3 CPIs and or NFPs. And if that is the case, why buy at the top to sell at the bottom? Buy at the top to sell at the bottom. Let's trade this from a perspective that we are still in a range in bonds overall, and we're still in a range in equities, but the range is going to be lowered, probably
right?
down into the 3700s, 38, high, low
Yeah.
3800s. So that is the way I'm thinking. SPX 3800 and slightly lower, and bonds 330 to 350 in fives is the absolute lowest that I can see for the time being.
Right. And so, just to close the last thing, we're a bit overweight in gold. Gold sold off a little bit. I'm not quite sure why today. Do you have any strong opinions on gold? I mean, it seems to be if the credit crunch is not as strong as worried, and the Fed doesn't respond quick enough, that you might see a nominal an inflation impulse that might support gold. I don't think we need to sell it.
No, I mean I'm absolutely not a seller of gold. I think it provides optionality to the portfolio, and
Well,
I definitely like to keep it for the time being. And as I said, the next 2 or 3 months we will know very little. We
yeah,
want to make room.
I think the idea of being very defensive on equities, because that seems very clearly going in one direction to both of us, and then basically being pretty short in terms of our cash, being heavily invested in floating rate product for gives us a lot of optionality in all assets and pays us 5%.
Absolutely. I think optionality is the name of the game. If the Fed doesn't know what's going to happen in the next couple of months, but it has some fears, okay, we have some fears too. But we think that this credit crunch might not be as bad as people fear. But on the other hand, we know how markets work, and they'll price in the worst possible thing that can possibly happen and then rally it from there.
Right. Okay, sounds good. Are you going to be able to do from your Mexican casita? Are you going to be able to do our position update?
I won't because I don't have the stuff with me. But
Sure.
I will do it on Sunday when I get back, and I will post I'll post the link then to the video that I will do. But in
Oh,
any
right.
case, it's very simple. We are reducing our equity allocation down from 30% down to the minimum of 20%. The money that we raise, we're going to stick into floating rate notes or 6-month bills. Your choice. It really is as simple as that. And all the other positions stay exactly as they are.
Okay. And Nick, you're coming back Sunday. Um, When do you think we're going to have our next episode, just so we can inform the viewers?
Whatever you say, we need to do. I'm flexible.
Maybe we do something either Monday
Yeah,
and then tell the viewers that we're back on our normal weekly schedule from there.
absolutely. Let's do one on Monday then. I'll speak to you then.
Okay. Well, thank you for watching, and we will see you on Monday.
Thank you. Bye bye.